Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Hey, good evening. This is going to be our first Q&A episode. You guys had questions. I've got answers. And if you have questions, odds are somebody else had that same question. So I want to make sure we put a video out answering these questions so that everybody can learn. So first question was from Rick. He says, thanks, I'm trying to teach my kids this dynamic banking concept right now. I have a first lien HELOC with a direct deposit, as well as 0% credit cards to pay bills with. And then I pay the credit cards off with the HELOC. Everything is on auto pay. Pretty slick operation. And his question is, it's actually kind of funny that I have to take enough money out of the HELOC to deposit to a checking account, then turn around to pay the interest charge back to the HELOC. Go figure, but that's the gymnastics they require. Do you know of any banks that won't charge you a monthly fee for a low balance? B of A charges $7 per month if you're under a $1,000 balance at any time during the month. So his basic question was, he's doing the dynamic banking, but he wants to know, are there banks that don't charge any monthly fees? And yes, there are banks that don't charge monthly fees, but there's also credit unions that don't charge monthly fees. And my suggestion is, check the credit unions in your local area. Overall, credit unions usually offer you a much better value for account holdings. I have my HELOC at a credit union, and it happens to be the same place that I do my checking. I leave about $300 in the account at any given time in the checking account, because through trial and error, me and my wife have figured out that it's a problem if we have less than that in there, because she doesn't like to check it before buying groceries or spending money in order to make sure that we transfer to cover whatever needs to come out. So having the HELOC at the credit union where I have my checking account, I find it's really easy to just do transfers at any time. And when I pull money out of the HELOC and I put it into my checking account, it happens instantly. Now, when I do the reverse, when I get money into my checking account and I put it into the HELOC, it takes a day to cycle. Once they verify the funds are actually in there, then they'll move it into the HELOC. And then I'm offsetting my interest in the HELOC. But for the most part, it works really well to have them at the same institution. Online. I also recommend that you check online banks. I know there's a number of those out there that offer free checking. And Michael says, I like your approach. Getting rid of the high interest credit card debt both saves on overall interest payments and also builds back cash flow more quickly. Yes, it does. We've got the next question from Kat, who says, this was in response to the dynamic banking episode. And they say, so all that work to make $31? Why not just sell drugs? Good question. One, selling drugs is illegal, but doing dynamic banking is not illegal. And it's a little more, it's more than just saving on that $31. It's not actually that much work either. When you have your HELOC and your checking account, or your personal line of credit and your checking account with the same bank, it's actually pretty easy to move those funds back and forth. If they're in separate banks, you might have to jump through a couple more hoops, but for the most part, it still isn't that difficult to do. It's not just the $31 in potential interest saved from the paycheck parking, but it's the interest that you save and the interest that you potentially earn from chunking down other debts, the increase in cash flow that you get, the cash back rewards from using the credit cards, and the ability to have access to all of those funds as you simultaneously throw all of your extra cash at the debt. When you put it all together, it's a much better approach than to just pay extra principal payments. And finally, there's a psychological shift that happens when you get into doing dynamic banking. And it's this mindset that you're paying off debts quickly and you're maximizing your cash flow. That psychological shift is really motivating to continue doing this. On the flip side, if you're just putting extra money towards a debt, there's no extra incentive there. You're not changing your mindset to a debt pay down mode. Now, for some people, it can work, but overall, I think we see more savings when we do dynamic banking with the paycheck parking. And Michael says, finally, a straightforward presentation of dynamic banking, also known as velocity banking or offset accounting. This video puts the interests of the person who really needs help first without charging them an arm and a leg up front. I strongly recommend it. Thanks, Michael. That is our goal. That's why we're doing this. Rick says, one of the most important subjects on finance ever. Why don't you have 500,000 views yet? To which I say, we're a new channel. Give us some time. Hopefully we'll get some traction. Now, Rick says, good information. I've been looking into this for about a year now. I'm just about age 60, which is why I have been reluctant to dive in. I've heard that you can take out policies against your children. How does that work? This is in reference to infinite banking. Infinite banking is a cash value life insurance policy that is designed to store cash and serve as a savings type asset. First, let me say that the difference between taking out a policy on yourself and taking out a policy on your kid is not much different as far as the design goes. The difference will show up in how much insurance each party would get. So for the same amount of premium, your kid is going to get a lot more life insurance than you will get. But the policy performance will be very similar because our cash value and our MEC limits are going to be the same or very close. So 60 is not too old to start an infinite banking policy by any means. And your kids will have a tax-free death benefit at some point. So if you start the policy on yourself, they're going to get a tax-free death benefit, and they can use that tax-free death benefit to start a policy on themselves at that time. Or maybe they have another need in their life that they could apply it towards. Usually people don't look to start one on their kids unless they can't qualify or if they have some other health issue that gives them a rating that the policy just doesn't perform as efficiently. And that would increase the insurance costs beyond regular levels. All other things being equal, the cash growth can offset the insurance cost, whether the policy is on you or on your kids. And oftentimes people will start out with policies on themselves, and then later on they'll get policies on their kids when they want to put more money into these things than what they can do into their own policy. Now, to directly answer the question, taking a policy out on your kids works the same as taking it out on you, except if they're over 18, you'll have to get their permission because there's going to be a medical exam. The policy design is exactly the same though. The general rule is you can get a life insurance policy on anyone that you have a financial tie to, an obligation of sorts. Anyone that is reliant on your income and anybody who you're reliant on their income. So business partners, parents, spouses, kids, and grandkids, all fair game, including employees. If you own a business, you can get insurance on your key employees also. So thanks for that question, Rick. And he follows up with, thanks for clearing that up. I also understand that commissions as well as the mutual insurance company's dividend performance based on mortality experience, investments, expense charges, and lapse rates. I know that the highest rated mutual insurance companies are Mass Mutual and Penn Mutual. Do you use one of these? So I'm contracted with Mass Mutual of those two. I'm not contracted with Penn Mutual. Of the four major mutuals, we've got Northwestern, New York Life, Mass Mutual, and Guardian. I'm contracted with Mass Mutual and Guardian. So there's advantages to each. I tend to use Guardian because it's the most flexible, but it's really whatever is going to fit your needs best. The dividend rates over the last decade have been highest from Mass Mutual, but whoever's highest can and does vary over time. So we tend to not put much weight into who has the highest dividend rate currently. What we want to make sure is that the policy fits how you plan to use it best. So we tend to not put a whole lot of weight into any given year as to who is the highest dividend, as long as their long-term track record is really good. That's why we call those 4 companies above the 4 major mutuals. They've had the longest history of uninterrupted years paying dividends. Now, Penn Mutual is just behind Guardian in the most recent 10-year and 15-year average. And they're just about even with Northwestern and New York Life when it comes to that 10 and 15-year average dividend payment. The biggest difference between Mass Mutual and Penn Mutual is a non-direct recognition variable option loan. Now, there's pros and cons for non-direct recognition and direct recognition, and how you plan to use the policy will dictate which design is going to work better for you. Now, Guardian and Penn Mutual both have non-direct recognition policies. So the other thing to be aware of is the premium load charges on the paid-up additions riders. Mass Mutual charges an 8% load fee. Guardian charges a 5% load fee, and Penn Mutual charges a 15% load fee in the first year, 8% load fee each year after that. So what that means is if you pay $100,000 above your base premium, with Mass Mutual, there's going to be $8,000 load fee. With Penn Mutual, $15,000 load fee. And with Guardian, $5,000 load fee. And how that works is that gets subtracted from the $100,000 before it buys your paid up additions. And that's what becomes your additional cash value in the policy. So the lower the load fee, the better. It's not always a huge difference. Like between Mass Mutual and Guardian, the 5% and the 8%. Not a huge difference in load fee, but that 15% load fee from Penn Mutual is pretty high. So hopefully that makes sense. If not, we're going to go over all of these types of things in future videos. So this was a question in response to the infinite banking video. The best classical music says, you still have to fund the premiums though, right? So $100,000 for bonuses, but you need to also ensure you can pay the yearly premium as well, correct? Also, we should pay the loan back too. I'm asking as I'm about to buy a $40,000 car for my business, but don't have a policy. I figure I would need an $80,000 policy, $40,000 premium, if I want to do this. Unfortunately, I generally only have $30,000 to put into the policy. I should have done this 2 years ago. My response is, the yearly premiums are something you would likely want to continue to pay. However, that depends on your policy design. Some policies can be set up to dump in a lot of money over the first few years and then shut off the premiums so you don't have anything more due. At that point, the policy will just continue to build off of the funds that you've put into it. You can still borrow and repay to that account, but you can't add any more premiums at that point. That design is really determined by what you want to do with it. Now, as far as paying back the loan, it depends on what you would otherwise do with the funds. The easy route is to just pay it back and then borrow it again if necessary. That's the best way to handle recurring expenses so that you know there's always enough in the account to make the next payment. Now, as far as this vehicle situation, one thing that you can do is to get a low interest loan on the vehicle. Auto loans out there right now are incredible rates, 0%, 1.9%, 0.9%. So you can start the policy with the cash that you have and then just make payments on the vehicle. Your policy will end up getting a chance to grow and you'll earn more than what you end up paying on the auto loan. You can end up paying back the auto loan at any time with the cash value that's in the policy if it makes sense to do it. But more than likely, you'd be better off just letting the policy mature and grow in value while you pay off the low interest auto loan. So that would be my suggestion on how to handle paying for that vehicle. Jason asks, how do I incorporate infinite banking into my velocity banking strategy? Do I just use velocity banking to eliminate my debt, Then once I'm debt free, get a whole life policy specifically designed with cash value. That is one way that you can do it, but that may not necessarily be the best way to maximize those uses. So it depends on your situation and your goals. It might be beneficial to start your whole life policy prior to eliminating all of your debts and possibly right at the beginning of your efforts here. So I personally use a whole life policy to store my emergency funds. And ideally, you would have some emergency funds when you start doing the velocity banking strategy. Also, you may find it more beneficial to leave some low interest, long-term debt in place while you build your infinite bank. Deciding what is best for your situation involves understanding your whole financial picture, the different options that you have to work with, your personality, and your investing approach. So hopefully that helps. That's it for today's Q&A. Thanks for joining me. If you have any questions or comments, leave them in the section below. I'm happy to answer them, and I look forward to hearing from you. I really want to thank you for joining us today. It's our hope to help you take control of your finances, maximize your cash flow, and reach financial freedom. If you found value in today's video, please give it a thumbs up, hit the subscribe button here along with the notification bell. That's how we know that you guys are interested, and it gets us motivated to put the next video out real quick. If you have any questions or comments, join us in the conversation below, and be sure to let us know what financial freedom means to you. Now go maximize your cash flow.